This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
You can trust the headlines and politicians if you want, but I'll take my guidance from the markets. They're saying the war is over, or at least about to be. March's showers have given way to April flowers, and amazingly, stocks are already back to levels before war broke out. Up next, let's make sense of yet another V-shaped recovery. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Well, whether you think the war is over or not, I don't know if it matters if you're an investor because the markets have declared that it is, or at least it's about to be. Now, we all know in reality that it's a lot messier than that. The headlines will likely be volatile. Who knows what the fall-on economic effects are going to be of all of this? We will stay tuned for that over the coming months. But ostensibly, the markets have really already started to move on, as witnessed by the fact that we're back to levels in the S&P and the Dow before war broke out. I know it's amazing, but that's been our track record. That's been our history with geopolitical events. And that's why I've said, and Chase has said the same thing over the course of the last couple months, be careful overreacting to geopolitics. Look at Ukraine. The fighting there is arguably just as intense as it was 4 years ago, but the markets stopped caring about a month in. Well, we're a little over a month in this time around. Again, S&P back to an all-time high. So read what you want into that, but that's been the track record. That's why we were so adamant about, hey, don't overreact. Don't do a lot of selling just because you're spooked by the headlines unless you really need to. But let's also put a bow on what has happened. It has been a very challenging, couple of months, right? The S&P finished March 31st as essentially the worst quarter in 4 years. I had a client just ping me this week and say, why did my portfolio dip last month? And I said in a very polite and professional way, have you been living under a rock? Because it wasn't just stocks, right? Outside of energy, stocks were very challenging pretty much across the board. But bonds sold off. Many commodity markets sold off. Precious metals sold off. Cryptocurrencies sold off. There was nowhere to go. In fact, at one point, as you know, the S&P had gotten within a very small margin of that proverbial 10% correction threshold. As of March 30th, the S&P was down 9.8% from its January high. That's the biggest correction, of course, since this time last year when the tariffs came out, and the longest correction since the 2022 bear market. Just a couple kind of factoids that I found interesting, but also instructive. I saw this on FactSet. They looked at the Magnificent Seven's outsized impact on the S&P 500 during this decline. So from the start of the year, when the S&P was back to 68.46, through the end of the first quarter, when the S&P was down at 65.29, so what's that? A little over 300-point decline, okay? Microsoft alone contributed 94 points of that. Google, 37 points. Apple, 29 points. NVIDIA, 29 points. Amazon, 27 points. Meta, 27 points. Tesla, 23 points. Get this. The other 493 names in the S&P 500, only 51 points. So Microsoft darn near contributed twice to the decline in the S&P 500 as the other 493 names combined. So if you're wondering about the Mag 7's impact on the markets, good or bad, look no further than that data. Okay, and of course in March we saw the downside of that reality, right? But when we got to those lows, I thought it was very interesting that the consumer sentiment, investor sentiment figures were overwhelmingly bearish. I saw from Bank of America that fund managers were the most bearish they had been since June of last year. When you get that type of extreme negativity, that's often when and where you get the bounce. On cue, the NASDAQ since that time has rallied for 11 consecutive days now, if you count this week. 11 consecutive days, up almost 14% over that 11-day period. It's happened before. If you go back to 1990, according to FactSet, 10-day or longer winning streaks have occurred 12 times prior to this one. And they note that in the ensuing 12 months, the 12 months that have followed, NASDAQ has gained another, on average, 16% and been positive 83% of the time. So this type of momentum, it's not a 100% trigger signal, but history suggests that it is much more of a bullish signal than one to be feared, than a bearish signal. Okay? Semiconductors specifically, chip stocks, also up over 10 consecutive days, up 30% in aggregate, 30%. Over that 10 days. Again, over the 4 prior occurrences that has happened, this is also FactSet data, there's been a 100% hit rate on continued gains over the next 12 months. So I'm not in the prediction market. I have no idea what the next 12 months are going to bring. I'm just telling you that history says this type of momentum and performance reversal is to be more cheered than feared, even if things may have gotten a little bit ahead of themselves here in the short term. I think the lesson is that, as I said about Ukraine, the markets will often send a signal, will make a determination well before the mainline media and headlines say something, or even before things have actually happened. It's just that the markets are essentially saying, you know what, we're closer to the end of this than the beginning. We're going to move on. It's a good lesson. It's a good lesson we should all remember going forward. But just, again, looking back before we look forward, I just want to provide a few reminders of things that I've talked about ad nauseum over the last 20 years on the radio and podcast, but particularly in times of stress. Just a few lessons. 1, ignore the soothsayers. Okay, ignore the soothsayers. Particularly the geopolitical soothsayers, right? I mean, nobody knows what Trump is going to do, what Iran is going to do at any given time. Yes, you can talk about historical precedent for certain things. People issuing commentary and headlines didn't know anything more about the timeline on the war and the timeline on de-escalation than you or me. They really don't. They're just speculating. And nobody knows when the timing at which the market is going to shift in direction. Okay? It's just not worth listening to people that think that they know that how this is going to turn out. At no point in the past few months have Chase or I issued a market prediction as to when, the extent of the decline and when things would recover. We're smart enough and experienced enough to know that that's an impossible task. So don't try to do it. Don't bother listening to it. 2, avoid concentration. I mean, it's kind of an obvious, but as we've seen from the huge swings in various asset classes, pretty much all asset classes, being concentrated in one particular area, being leveraged to higher rates or lower rates, being leveraged to AI or against AI, being leveraged to international versus domestic, long-term rates versus short-term rates. Whenever you concentrate in a certain market direction, a certain asset class direction, a certain stock price direction, you are asking for trouble. What have we learned in the past 6 months? We've had huge swings in both directions in all those things that I mentioned. Last year, international trounced U.S. During the war, the exact opposite, right? AI went from being a market leader to being the worst place to have your money to actually now starting to look attractive again. I could go on. Point is, keep portfolio balance. Have your portfolio be able to weather a multitude of outcomes, okay? And accept the cost of that diversification. Know that if you are balanced, if you are diversified, at any given time, you could be lagging. So obviously, if you were less correlated with the stock market, you probably underperformed earlier this year. You probably outperformed in March. Maybe you're underperforming a bit again the last couple of weeks, okay? I've said this a million times. I'll keep saying it. If everything in your portfolio is doing well at the same time, you're probably doing something wrong. Why? Because under different conditions, everything could be performing poorly, right? Accept the cost of diversification. Know that you're not going to be on all the hot dots at the same time, but you are going to be positioned when things turn and go in a different direction. I mean, again, I'll use Mag 7 as a great example. If you had some participation there last year, of course you did very well with that participation. You did very poorly with that participation late last year and early this year when the markets rotated into other areas. Now you're starting to look good again. If you've had that balance, that diversification, you haven't always outperformed the markets at any given time, but you've had much more consistent returns. All right, I'll leave it there. Last thing I'll say from kind of an emotional investor, harvesting our own emotional perspective, be wary of two things. Recency bias is one, right? I think it was very tempting in March for people to get caught up in how much their portfolio is down, right? What are their losses? Well, what are you measuring against? Think about that. Are you measuring against the highs of February? What if you widen your lens a bit and look at where you have been over the last 1 year, 3 year, 5 years? I can't speak for everybody listening, right? People have varied returns. But if you've had a decent amount of stock market exposure, you probably have some level of return over the past 1 and 3 and 5 years that is likely significantly higher than any sort of pullback you had in March. Again, I'm generalizing here. I know there are exceptions to that. Widen the lens when things get tough. And be careful of anchoring. There's this kind of emotional conceit that many of us have where we anchor to the highest price that something's ever traded. People do this all the time with their homes. They remember what their houses were worth at the peak of a housing bubble or the peak of COVID prices and think that that's the absolute price that they're entitled to. Same thing of a stock. If a stock hit an all-time high in February and you're 20 cents below that high, you think that that high price is where the stock should be. Well, those prices are just a function of the conditions at the time. If the conditions have changed, different pricing could be warranted. Be very careful. You start to make mistakes in asset management, portfolio management, where you're not managing for the future prospects of the investment. You're managing based on where it's been, what the high was. Keep that in mind. Look at yourself in the mirror and say, am I doing this? All right, let's move on. Well, we certainly know from history that a bad start to the year does not necessarily mean that there's going to be a bad finish. So I looked at some data from Charlie Bolello over at Creative Planning. He ranked the 20 worst starts to the S&P 500 over the first 60 days. The start that we just had was ranked 12th worst, 7.3% decline over the first 60 days. Well, what's interesting, if you look at the full calendar year return for these 20 years, a ton of them were positive. In fact, more than half of them produced positive returns. And I will tell you a lot of the negative returns, one was 2008, one was in the 1970s. The rest tended to be around the Great Depression. So outside of sort of calamitous market conditions, deep recessions, odds are actually that this type of return gives way to a better year return, and that certainly was the case last year. So again, that's sort of the historical perspective. The folks up at Ritzold Asset Management, they looked at data going back to 1950, and they crunched all the times where stocks ended a month down 10% or more. Well, they found that, again, since 1950, you were up on average 15, 42, and 72% respectively on a 1, 3, and 5 years basis later. Okay? So these corrections actually tend to lead to higher returns going forward, not lower. There are exceptions to that, but they are rare. What happens to stocks after a surge in oil? Well, these same people, the Ritzold people, they also went back, they didn't go quite as far. They went back to 1986, looked at all the times where oil has surged 20% or more. Only once was the market lower a year later, and that was 2008. Okay, again, at the depths of the financial crisis. And then one more. What happens when volatility spikes? If you look at the VIX, VIX, which is a closely watched measure of market volatility, they looked at all the volatility spikes over 30, and we spiked just over 30 here recently in March. Forward returns over a 1, 3, and 5-year basis were higher than average market returns when that has occurred. So I won't belabor the point, but oil shocks, volatility shocks, market sell-offs, most of the time, unless the underlying conditions are really poor, like in '08, Great Depression, at times in the mid-'70s, tend to augur for higher markets, not lower markets going forward. So looking at this sell-off, again, looking in the rearview mirror just for a little bit longer here, I think what was really interesting about this sell-off is that earnings estimates were not collapsing. So analysts were not taking down their earnings estimates, which means that when the stocks pulled back almost 10%, almost all of that was due to multiple contraction, meaning, PE ratios, right? That people were paying much less for future earnings than they were as recently as February, okay? In fact, FactSet went on to say that stocks have never, they went back to 1990, stocks have never been down this much when earnings estimates have risen by this much. It has never happened. Pretty interesting, right? Markets arguably, and we'll get to the arguably part of it in a second, but markets arguably were much cheaper in March than they were in February. It'd be different if earnings estimates were collapsing, because then you could have seen PE ratios actually go up, right? Because the earnings were going down, all right? I'd say a couple things about this. One, over short periods of time, stock prices and earnings actually have a pretty weak linear relationship. If you go back, 100 years and you do kind of a scatter chart of it, there's really not much of a trend line that you can draw over short periods of time, 6 to 12 months between earnings and stock prices. But the other thing is the fact that the estimates themselves have actually been revised up. So since the war has broken out, earnings estimates have actually gone up, which is pretty nuts. In fact, I would also say that according to FactSet, the share of S&P 500 companies that actually issued positive earnings per share guidance this quarter is the highest since the third quarter of 2001. So we'll see what happens. We're just starting to actually get those reports. We're not getting, forecasts anymore. We're going to get the actual news. We started getting those on Monday. That will continue and really speed up over the next 2 or 3 weeks. We'll see where what the pudding looks like. The proof will be in the pudding. But so far, earnings estimates are still calling for about somewhere between 12 and 13% growth year over year. And quite possibly that's conservative. FactSet says actual earnings have exceeded estimates in the past 37 out of 40 quarters, if you can believe that. Of course, what does that mean? Leaves the bar pretty high, right? So the bar for disappointment is significant. I will also just issue a note of caution. In my experience, Wall Street analysts are slow to revise estimates following geopolitical events, market-moving events. I remember going back to Russia's invasion of Ukraine, and then the sort of the energy crisis that came out of that when oil spiked to $130 a barrel. Earnings estimates actually kept going up really through the summer of 22, even though conflict broke out in the spring, before analysts started to really model for slowing activity. So keep in mind, there is some precedent for earnings estimates and analysts in general being late to the game. I would also say, though, 22 is a bit of a strange example because, remember, inflation was running at 8 or 9% going into Ukraine. Okay, so inflation was already a major drag on the consumer. And then, of course, the Fed was starting to raise interest rates from 0% to 5%, which was another drag. So there was a lot of negative things going on in the economy well beyond the conflict in Ukraine that would eventually lead to earnings estimates being lowered. We don't know what's going to happen this time around, right? As I've said before, it's not so much how high oil got to, it was more a question of duration. We don't know how long oil is going to stay at elevated levels, but you have to believe there'll be some pinch on the consumer. I think that's kind of obvious, but we just don't know the extent of it. More importantly, we do not know the impact on corporate earnings, because remember, we had the same fear this time last year when tariffs came out that it was going to crush margins. What happened? We got the highest profit margins in U.S. history that are still elevated today. So corporate America successfully navigated that input cost surge. We'll see if they can do it again. It'll be interesting to watch, and hopefully we'll get some more information on that over the next few weeks as, like I said, companies report their earnings. A couple observations, a little more specific observations. One is technology. I said a few minutes ago, we all know how AI stocks and tech more broadly were dominant for most of last year. We also know that they were one of the worst places to have your money late last year and early this year, right? The bloom had very much come off the rose for AI and tech more broadly. We got to a point in March, according to Larry Adams here at Raymond James, where tech stocks got to their lowest relative valuation, meaning valuation relative to the S&P, since 2020, since the COVID collapse. And despite the fact that consensus estimates are calling for about 40% earnings growth for technology this year. So tech sold off significantly, and to the point where valuations on technology were trading below valuations in some of the more defensive sectors like consumer staples, utility, despite literally more than 10 times the projected earnings growth rate for this year. So that was very interesting. And we just to give you the background on this, you're probably aware of some of the market concerns, but just to kind of summarize, one, of course, is that the dramatic rise in capital expenditures from the so-called hyperscalers, the big guys, Google, Microsoft, Meta. People have been wondering if those are sustainable. Not only sustainable, but how they're going to be paid for. Do these companies have to float a lot of debt? Do they have to use all their free cash flow? So that, and not to mention, these companies are now more capital intensive than they used to be because they're actually having to put money into physical plants like data centers. So they're more subject to interest rates and capital costs that, quite frankly, could challenge their margins in the future. Secondly, people have wondered whether who's going to be disrupted, and Jason and I have both talked about this, that, I found it a little bit contradictory that people are worried that AI spending can continue, but at the same time, they're worried that AI is disrupting everything. So I would say those things aren't ultimately compatible. But there's been a lot of selling of companies that the market fears will be significantly compromised by AI, namely software companies, right, that have legacy, high cost, high margin, software programs that maybe can be replaced by cheaper AI models, okay? And then what else? There, as I mentioned, there's sort of this reconvergence of the virtual and physical worlds. Tech for a while didn't have to spend money on data centers and energy and, building energy infrastructure. So not only does the market worry about that spending, but it's also allowed more traditional industries like utilities, industrials, to achieve, in many cases, higher price-to-earnings multiples and take capital away from traditional tech companies. So those have been the challenges, but it left multiples at levels that, quite frankly, were significantly cheap relative to the still, pretty elevated growth prospects for these companies. One thing that we've noticed is that return on equity, ROE, for tech stocks has remained high. So I found that very interesting. It led to a record gap between performance and underlying earnings growth. So when I say tech, I'm obviously generalizing. It's a huge sector with a lot of nuance underneath the surface. But for the first time in a while, I would argue that tech was on sale in March. I don't think it's an accident that if you look at the last week and a half, what has led the charge back? It's been Mag 7, I mentioned earlier. NASDAQ's up 11 days in a row. Chip stocks up 11 days in a row. You've seen a bounce back there. And I would just say, in general, there's this kind of bubble talk. I've pushed back on that a lot over the course of the last 6 months. I still don't think that valuations are anywhere near, in technology, what we've seen in past bubbles. We're also not seeing a significant rise in stock issuance, IPOs, companies issuing new stock like we did at other bubble peaks. If you look at the dot-com era, companies were using their stock like currency, and it ended up being, pretty shaky currency at that. You're not seeing that this time around. So you're just not seeing that speculative excess that we've seen in other periods. And I would just argue that in general, secular growth stocks, again, it's a wide category, but secular growth stocks, according to a Goldman Sachs report this week, at the end of March, in aggregate, they were 20% below their October highs, secular growth stocks. And by secular growth stocks, they define that as excluding financials, real estate, and utilities, companies that grow sales by at least 10% during each of the prior 2 years, and where consensus estimates indicate sales growth of at least 10% in the current year and each of the next 2 years. That's how they define it. They found that group was on sale. So I don't know if I'm going to sit here and tell you that growth is value or that we should shun value stocks. But when you see NVIDIA trading at 20 times earnings and Colgate and Clorox trading over 30 times earnings, it gives me some pause. I think I referenced a few weeks ago that Amazon was trading at half the forward multiple of Walmart. And I'm not sitting here issuing a commentary on the merits of these names one way or another. I'm just looking at it purely from a valuation perspective. You could argue that the valuations are portending or forecasting a slowdown in earnings for tech. Maybe that's possible, but we haven't seen it yet. And as I mentioned, FactSet earnings consensus is calling for 40% growth this year. So maybe markets looking around corners at 27 and 2028. That remains to be seen. But that's something that we're going to be watching closely. And I would just say that in a general sense, there are stocks that were not on our radars 2-3 months ago due to excessive valuation that now look a lot more interesting. So that's something that we'll be talking about, I think, particularly if we get a little bit of a counter pullback or a little bit of a, steam comes out of this bounce balloon. I'm mixing metaphors here, but I think you know what I mean, here over the next few weeks. We'll learn a lot more, as I said, when we get the earnings report and companies are issuing more concrete guidance about how they think the year is going to play out. All right, I'm going to leave it there. I do want to talk a little bit about a few individual names. As I mentioned, we're getting those reports, so there are some more fundamental issues to discuss, which is good. I think, like you're probably sick and tired of reading and hearing about geopolitics. It's good to kind of drill down on earnings and sales and balance sheets again. So stay tuned. Back in a second, and we'll get into that. Midterm election years are almost always the most volatile, and so far 2026 is proving no exception. Will you let the inevitable churn in your political leanings disrupt your plan and portfolio? Tune in every week as we discuss the latest financial trends and what investors need to know. To avoid the endless barrage of distractions and become a better informed, wise investor, listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James & Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James & Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James & Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Do want to talk to you a little bit about some individual names. We're starting to get the first quarter earnings reports. We've heard mostly from banks so far, but I do want to get to a few things. Just remember, if you're a listener, please consult your own financial advisor before you act or make any decision. in terms of buying or selling any of the names that I'm going to mention. I think that's good practice. Also, before I discuss specific names, I'd like to disclose our conflicts. I own these names personally, and so do a number of our clients. So incorporate that into your thinking. Wanted to mention a new name, a name that we started to add to many of our client portfolios over the course of the last couple weeks, and that is Eaton, E-A-T-O-N, a symbol ETN. And again, just started accumulating, I think for the first time. I can't recall owning this over the course of the last 20 years. If we did, it was a long time ago. Eaton was a much different company years ago than it is today. It was a fairly slow growth kind of electrical component, energy component company, low margins, relatively low PE. They've gone through a pretty significant transformation in their business. So there's still a global power management company. Like I said, they sell mostly electrical gear of all kinds. But now about 92% of their profits come from their electrical and aerospace segments. Again, that's a big change from what they used to be. And they're really in a position to benefit from a number of what I think are now secular trends: electrification, energy transition, digitalization, as well as an improving end market cycle in aerospace. And it's shown up in the numbers. Their sales and earnings growth has accelerated recently and is expected to significantly accelerate over the next 5 years. I read reports from JP and the guy here at Raymond James. They both think that return on invested capital that used to be in the low single digits should be in the low double digits over the next few years. So pretty significant transformation. And free cash flow generation should now exceed, in their estimates, actual earnings per share. Okay, so big transformation. More specifically, kind of what's moving them, they're heavily leveraged to data centers. Like many companies in their space, they're facing pretty significant data center backlogs. So there is a lot of visibility into future growth for Eaton. I mean, just their data center related earnings were up something like 200% year over year in the most recent quarter, up 80% year over year in Europe. They now have an 11-year backlog at current build rates. And their book-to-bill ratio, which is a ratio of new orders to existing, well above one. They also are really capitalizing on utility and upgrades to utility grids. They're going to benefit from that trend. I mentioned the aerospace cycle. They are nicely positioned there. They also are returning more money to shareholders. Consistent dividend hikes. They have a large share buyback authorization in place. So those are kind of the positives with their trajectory. I think the negatives are that to launch a lot of these growth initiatives and to participate in this growth, they're having to lay out a lot of capital. So their margins have actually decreased over the last couple of quarters, and actually that may continue through the rest of this year. Eaton's stock has actually lagged over the last couple of years. It's basically been dead money versus some of their competitors. I think a lot of it has to do with that bottom line margin profile. But the Eaton people, as well as the analysts I mentioned, they think that that's sort of the fleas that come with the dog, that they're having to invest in capital in order to get those growth initiatives off the ground. The price to earnings ratio is also elevated versus their recent past. But again, the analysts argue that's due to the fact that their free cash flow growth trajectories are so much higher, that is warranted. So, the risk to the story would certainly be overall AI spending and any sort of change in the narrative there, because that's where a lot of their profits are coming from. Valuation and margin execution would be the other things to watch. But I think at these levels, given the underperformance of the stock on a relative basis, versus their peer group, it could be an interesting name. So that's Eaton, symbol ETN. And by the way, if you're a client, you already know this. We didn't have a lot of industrial exposure in the portfolio. It's one of our lightest weightings. So if you've been, more levered to other sectors, maybe it's worth making sure that you kind of check that box and have some capital in this space. All right, I'll leave it there. We did start to hear from the banks this week. Two names I'll just highlight briefly: Wells Fargo and JP. I think what was interesting about the reports is more kind of what we didn't hear than what we did hear. There's been a lot of concern. I haven't gotten into it too much. Maybe I think Chase has a little bit, but there's been a lot of concern about private credit and how some of what you're hearing about potential bad loan exposure, particularly to software companies, smells a little bit like some of the credit issues that we saw leading up to the 2008 financial crisis. So that has spooked investors across the board in the financial space, even insurance companies, because they supposedly have a lot of exposure there as well. So the whole financial sector really underperformed or has underperformed over the past 6 weeks after being in a leadership position prior to that. I think what was encouraging, if you're listening to the reports this week, is none of the companies that reported really noted any major issues there or any major exposures there. Certainly Wells Fargo and JP both said not only have they not seen any real credit problems, but Wells Fargo noted that about 3.5% of their loans are exposed to private credit. JP about the same. So I'm not going to say it's a negligible exposure, but the CEOs, the CFOs on the calls, when asked repeatedly, really didn't see these exposures as material to them. We also didn't see any real degradation in credit at the consumer level. Now, both companies did slightly raise their loan loss provisions just to be prudent and conservative, but neither company really noted any significant rise in defaults. Again, these are things that we'll be watching, but when they were asked about their guidance going forward, they didn't feel the need to get significantly more conservative in their balance sheets. Wells Fargo reaction was not great by the street. The stock had rallied going into the earnings and pulled back probably 5% or so since their earnings, mainly due to some ongoing pressure on the bottom line, on their net interest margin. They said that has much more to do with interest rates and some lower margin business lines. The fact that short-term interest rates had come down. They did not see it as material long-term and still maintain their earnings guidance, their return on invested capital guidance going forward. Stock is now a lot cheaper than it was, down to about 11 times earnings, which puts them in the bottom half of their peer group. So Wells Fargo in general remained constructive on pretty much all their business lines, particularly with commercial credit, which is something they're looking to do a lot more with. Remember, Wells Fargo is playing catch-up. Because of regulatory constraints, they were not able to expand their balance sheet really much at all over the past 5 years. They are rebuilding that lending book and appear to be on track there. The risks, I think, are more at the macroeconomic level. Certainly, if this war in Iran, higher oil prices, sluggish labor market really starts to bite the consumer in a more meaningful way, that's going to be material for the banks. So we need to consider that risk. JP executing very well across the board. I think the risk there really is just valuation. If you look at the big banks, JP is the most expensive. If you've been following the banks for a long time, you know this is nothing new. JP has been considered by the street as best in class, and as such, they get a premium multiple. So what does that mean? It means that if financials are recovering from a trough like maybe they're trying to do in the last few weeks, maybe JP has less upside in that scenario because of that premium valuation. But I would argue that the stock also held up better in March when other stocks were really pulling back significantly. So again, you're getting what you pay for there. I wouldn't consider JP a deep value. That's probably the biggest risk to the stock going forward. But I was encouraged in both cases, as I mentioned, about really the lack of any meaningful disclosure or necessary disclosure around private credit. I think that was a good thing. I think I'll leave it there for now. There'll be a lot more coming over the course of the next few weeks. Like I said, we heard from the banks initially. We haven't heard from any of the big tech names. That'll, of course, be newsworthy. So stay tuned. But I do, as I mentioned, welcome being able to focus on good old-fashioned fundamental analysis, not just sitting back waiting for the latest Trump tweet. I think that's refreshing and good for all of us. Hope that was helpful, and as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the WISE Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.